Welcome to the daily update, where I'll go over the action in the market for Friday, September 29th, and then we'll see how things look for Monday, October 2nd. We started out pretty good on Friday. We actually gapped higher, but unfortunately, right at the open is when we set the daily high, and then we chopped sideways and then ended up falling even lower than that. So we're still negative, but there could be some positive things developing that I will try to point out as we go through this video. Let's go back and talk about what happened. Right at the open, we did have a gap higher open to R1 at 43.23, and we got a little bit above that at the August 2022 high. That set the high for the day. We wouldn't get that high again. As the day went on, prices pulled back. We went down to the unchanged level, which on an update often acts as support. Nope, didn't happen this time. We dropped not only below the unchanged level, we went down below the daily pivot at 42.94. We found support at 42.75. That's kind of a round number. Again, this was the last day of the week, the month, and the quarter. 42.75 might have been important for some reason, but we were able to find some support there. We rose back up to the unchanged level, which now acted as resistance before pulling back, and then we ended up closing back below the daily pivot. So we were down 0.27%, not a big move percentage-wise, but it was a down day after we had seen a couple of up days. We're above average with volume, and our technicals in the short term were still negative, but we're dealing with an oversold situation. Now our list is getting a little shorter as it is in the intermediate term. Both of those are negative. We're still positive in the long term. It has to do with inflation, interest rates, what the Fed is going to say. Now it looks like we're going to be dealing with the government shutdown and all of the different things that can bring about. So what are some comments that we can make? Early strength in the day gave way to late day selling, and then interest rates were down. They gapped lower, but then they spent a lot of the day coming back up and up and up and up. As they were going up, stocks really started to go down, so they climbed off of their lows. And that, even though they were down, even at the close for interest rates, it still put some pressure on stocks. Micro caps are still above 100. That's not a magical level. It's just a line that I've chosen to look at to say, okay, if we drop below 100, things are getting more negative. As long as we stay above 100, they're more positive. Here's our list for the short-term oversold indications or extreme negative. We have the 20-period exponential moving average. It was on the list, then it was off. Now it's back on. The Stochh RSI, the Williams percent are also back on the list. The CCI 20, the 14 is still off the list. The stochastics and our standard deviations chart. Intermediate term, we have the 50-period exponential moving average, which is back on this list. Some areas of the PMO studies are still extreme. And then we're wondering about the Chaikin money flow. We don't use that like an oscillator, but it's coming off of an extreme negative reading. And then this scenario that the economy is stronger than expected and that rates will be higher for longer. Now the variable is the Fed going to have to come in and raise interest rates? And that's really spooking the markets right now. Plus, we're just coming off of a period of pretty weak seasonality. And then the Fed might even have to raise interest rates if we continue to see a lot of strength in the economy. We're keeping an eye on China's economy, and then oil has been producing some inflationary concerns. The scenario that I came up with that I thought might last for a day or two, when I first came up with this, I thought maybe it'll take a few days to get to this, and then once it happens, it'll be done and over. No. We're still dealing with this right now. We're coming down to that longer-term trend line, and we're dealing with an oversold situation. And then we're also coming to the latter part. We pretty much have passed now this weak seasonality, and that still is playing out. And I'll show you the chart when we get to that point. The dollar was down and interest rates were down. But as I said, even though interest rates were down, they spent a lot of the day coming back up, and that pressured stocks. The 30 to the 5 is still remaining more regular now, where all of our other yield curves remain inverted. Sentiment ticked down to 28, where it had been at 29. Our trend is still negative. The red line's on top, even though it's declining both in the short and intermediate term. And the trend is also getting stronger because it's above its moving average. So we are in a confirmed negative trending environment. Our bias is mixed. Even though we had the down day, the market is really lacking conviction right now. And I've kept our momentum at mixed as well. economic reports. And I don't have all the charts to show you, just kind of the more influential ones. Personal income came in up 0.4% month over month. That was lower than the 0.5% they had expected, but double what it was last time. Personal spending was up 0.4% month over month. That was weaker than the 0.5% that they had expected, and also weaker than what we saw last time, being up 0.9%. The PCE price index came in as expected, being up 0.4%. This is the big one as far as inflation is concerned. The core PCE price index was up 0.1%, much weaker than the 0.4% they had expected. On a year-over-year basis, the index is up 3.5%. Last time it calculated to being up 3.4%. Then the core, which actually dropped down, it had been at 4.3%. This time it's now coming in at 3.9%. The advanced trade and goods, these are the charts that I won't show this time. We came in with a deficit of 84.3 billion, which is actually down from the 90.9 billion that we saw. Wholesale inventories were down 0.1%. Last time they were up 0.2%. Retail inventories were up 1.1%. Last time they were up 0.5%. The Chicago PMI, which can be influential, came in at 44.1, weaker than the 48.3 they had expected, and also down from the 48.7 that we saw last time. Consumer sentiment, the final reading, they had expected it to come in at 67.7. It came in at 68.1. So a little bit better than last time. If you take it back a year ago, we came in at 58.6. So people are not really happy, but they're a little happier than they were a year ago at this time. Here's the chart of personal income and spending. First, we look at the income, which is the gold line, where it's pretty much right about at the 5% level. And then spending, which is still positive as well, but did see a decline. The core inflation rate on a year-over-year basis continues to decline, and that's more market friendly. That's what gave us the gap higher open. But I will tell you, even before that report came up, the futures were looking pretty strong anyway. Personal spending on a month-over-month basis did decline from the previous month. Consumer sentiment, we look at the blue line, which is the total. That's the number that we have on our chart that I'll show you in a moment. And then when we look at the present time, that's the purple line where it is coming down, and we're actually seeing future expectations show a bit of improvement. Sorry about that. Here's the Chicago PMI coming in at 44, a little bit lower than it was last time. We're also keeping an eye on the 10-year yield. Whenever it gets above 4.02%, according to this research, that's when it starts to give the market some problems. Even though we ticked down in Friday's session, we're still at 4.57%. Here's the intraday chart where we gapped higher above R1, and then we set the high, boom, right at the open. We chopped more or less sideways. There wasn't a lot of gyration. We danced along here as the market was trying to decide what to do. We also got above the August 2022 high, which now may be providing overhead resistance before starting to fall down to the unchanged level. We dropped below that. We dropped below the daily pivot. We found some support at this 42.75 area before seeing a little bit of a bounce back up to the unchanged level, which now acted as resistance before trailing off into the close. Here's looking at growth versus value, where growth was up slightly, value ended up being down. When we look at S&P growth versus value, we're seeing something that could be positive. This is something in the background that we want to keep an eye on. Ever since about the 21st, we've been seeing growth outperforming value for the S&P. So eventually that might end up leading to something. On an end of day basis, we ticked down overall, but we're chopping sideways. And we were seeing some improvement here on a closing basis, but it's not really coming through to that chart. That's why I wanted to show this, where we're actually seeing a little bit more strength. Looking at our trend, where we are showing a strengthening trend, the ADX is above its moving average, the ADX is above 20, so that's a trend. The red line is on top, so we default to negative, even though it's declining, and the green line is coming up slightly. Short term, seeing that same thing, the ADX is above its moving average, they're both above 20. That's a confirmed negative trend because the red line's on top. We had come up close to this 40 area, and maybe we're starting to pull back now as the green line is trying to come up at this time. We're keeping an eye on the VIX, where if we continue to go up with the VIX, that means that stocks are going down, and that ends in about the middle part of October. Here's the VIX on the daily chart. Looking on the line chart, we were pretty much unchanged. But this is interesting. When you look at the bar chart, we really gapped lower with the VIX and then spent the day coming back as prices started to go down. We're seeing volatility of the VIX also not really changing all that much. Here on the line chart on the bottom, as well as the bar chart, we're still above the moving average, though, suggesting that the volatility of the VIX is still relatively high. Here's a fear gauge that we follow, and that did increase in Friday's session. Here's the VIX to VVIX ratio, which it's continuing to go up. That's longer term negative. This is shorter term positive, where we're seeing the 5-period simple moving average of the equity put call ratio. It's now declined 2 days in a row after giving us an extreme reading. If that can continue, that might mark some kind of a bottom in the market. But longer term, we're still going up, and that's negative. We need to see this turn back down to turn more positive. The Ulcer Index continues to climb, and looking at the advanced decline line based on price, we're just above the moving average, where we're below the moving average based on volume. New highs, new lows, even with the downward movement, we didn't see much of an expansion of either one. So our 5-period is declining and our 10-period continues to decline. The advanced decline ratio is chopping around a little bit, but still below zero. That's negative. Accumulation distribution still below a declining moving average. That's negative. Shaken money flow, it's starting to come back up just a little bit. Did we get some kind of an extreme negative reading right now? And is that going to mean that the smart money is going to come back in and begin to buy? Looking at our ratio between risk on and risk off, we're seeing a little bit of a bounce here, but longer term, we're still declining. And then we're looking at the American Association of Individual Investors, their latest reading. A week ago, things were negative and they reacted to that. So they're below zero, but not giving us an extreme reading. Here's consumer sentiment, where we did decline with the blue line. We're continuing to go up with the red line, which is the 2-year yield. And they're quite far apart from each other. And it's been that way now for about a year. And so the usual relationship that we had been seeing before is still remaining unusual. All right. Then looking at the cumulative NYSE advanced decline line, we're chopping down. We broke below this previous low, but we haven't come back down to this other low further back. And we're still below an advancing trend line with the regular NYSE advanced decline line. Here's the daily chart, where I thought we'd come down, hit this, and either just slice right through it and keep going, or come down, hit it, and then boing off of there. Well, neither one has really happened to this point. We're kind of right on the line currently. And then down at the bottom, we did have where volume was above average. The Stochh RSI is still extreme negative. The Williams percent R just ticked back into being extreme negative. The CCI 20, even though it's turning back up slightly, is still extreme negative. The stochastics in the short term, we're turning back down to being extreme negative. We're going up in the intermediate short term, but still extreme negative, turning back up in the long short term, and also extreme negative. The Force Index is coming back up closer to the midpoint now. It's still negative because it's below zero, but showing some improvement. This is also a potential sign of improvement. The Swenlin trading oscillator, we're starting to go back up based on price and volume, even though we're still below zero. The go-no-go system is still deep purple. That's negative. TTM squeeze continues to decline. We're wondering, are we going to hit some kind of a level where other times that marked a bottom in the market? The balance of power is still negative, below the dashed line. Our moving average study, we're getting extreme negative with the 20 and 50 period. We're declining just slightly with the 200. The bullish percent index, even though we're still declining here, this is green, and I know that's hard to see, which means it closed up higher than it opened, but we're still looking negative overall. Summation index based on price and volume continue to decline. The NYSE summation index, also based on price and volume, are declining. The elder impulse system for the S&P remains at neutral with a blue bar. We're also coming down to previous lows with our 200-period moving average study for the S&P. We're also coming down to previous lows with our 50-period moving average study. But on a momentum basis, we're still negative. The PMO is declining. It's also declining based on price and volume. Our PMO studies, after getting extreme negative, we tick down just a little bit, and we're looking a little more negative with the PMOs that are rising. And the buy signals continue to be extreme negative, where we're flattening out, but still negative with the PMOs that are above zero. The NYSE bullish percent index is below 50 and declining. That's negative. This is potentially positive. It's the NASDAQ 100 and the big mega caps that really helped the market go higher earlier in the year. Is that starting to happen now? That's meant to be an open-ended question. Based on Friday's action, even though the NASDAQ 100 was up slightly, not very much, but it was up where the S&P was down, we're seeing some improvement here with the bullish percent index. It's still negative, but we want to be watching for this. The slope indicator continues to be extreme negative, and we're wondering, is this really extreme, and will it start to turn and go back up? We're seeing a similar reading here with the MACD, where it's now matching where it was back in March, which at that time marked a bottom in the market. All of our oscillators, though, continue to be negative in the short, intermediate, and long term. Our moving average treaty, and this is interesting. Look at the pattern here where we were coming down. We dropped below the 200-day exponential moving average, which a lot of investors don't pay attention to. That's why I plot them both on here. And then we were coming back up, and this is actually looking a little bit better. We're seeing a very, very short-term series of higher highs and higher lows. Now, we closed down on Friday, and our momentum is still clearly negative, but is something starting to happen right here just based on the price chart by itself? Looking at our standard deviations chart, we're right on the border between -2 and -3, so we're showing a little bit of an improvement there. But the parabolic SAR continues to be negative, and we're still below this 100% retracement level for the S&P. This may be acting as overhead resistance now, and this also goes back to that previous August 2022 high. We're also dealing with this 61.8% retracement level. Can we get above that and then end up closing above that? That would turn things more positive. Until we can do that, this resistance may push us back down. We're also looking at the longer term fib chart. We haven't reached this double fib line here yet. We're just keeping this on here in case prices really start to decline. We're still above 100 with the microcap index. Nothing magic about that. Just we tend to be a little more positive. Here's the longer term trend line where we, instead of coming down and just bouncing off of it like a bumper car, no, we came down, fell through it, came back up, fell down, blah, 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 blah. Then we're just about right on that line currently. So the market is rather indecisive. Then David Keller from stockcharts.com. This chart wasn't updated on Friday. It was updated on Thursday. He is suggesting that we're seeing a confirmed head and shoulders top. And if that's the case, this could be quite negative for the market, since this tends to happen before we see a real solid decline in the market. The Heiken Ashi is looking a little bit better with an open candle, but we're seeing a lot of black candles right behind it. The Kegi is still red. That's negative, but it's pointing up, so that's showing some improvement. The Renko chart is still negative, and the three-line break is also negative. We were able to get above the 200-day moving average for the Dow, but then we lost it and closed down below that level. We are back to negative after being neutral for the Elder's Impulse system for the diamonds. And this is looking a little more positive too. See how we kind of came down with the NASDAQ 100 and we're seeing a series of higher highs and higher lows. That could be positive, but we have some significant overhead resistance and we don't have really any confirmation of things changing yet, other than what we see right here. All of our other indicators are still negative. The Elder's Impulse system for the QQQs remains at neutral. And looking at the NASDAQ 100, we never came down to the 61.8% retracement level. We got close, but not quite there, so we want to keep an eye on this. And we're also showing a little bit of an improvement with the NASDAQ, also starting to go back up. It hit this pivot level, which is now acting as overhead resistance. Here's the NASDAQ, where we're dealing with the 50% retracement fib level, where we are chopping above and below it right now instead of just hitting it and turning in the other direction. Look, keeping an eye on the FANG index, where we came down to this previous low and now look like we're starting to go back up slightly. Again, other than what we see right here, there's really no confirmation that things are changing yet. We need to see further confirmation from our charts. The small caps, not really showing a lot of strength. They came down to this pivot level and ended up being down in Friday's session. They're also below their 200-day moving average. Also wondering here with the Russell 2000, left shoulder, head, right shoulder potential. That could be negative for the small caps. And we're still negative with the RSI. We're negative with the MACD, even though it's rolling up slightly. The small caps remain at neutral for the Elders Impulse system. The mid caps are still below their 200-day moving average, and the mid caps are still neutral for the Elders Impulse system. Dow theory, we were down with the Dow, actually showed a little bit of relative strength with the transports, and we're continuing to show weakness for the utilities. Keeping an eye on the transports to S&P 500 ratio, this is going back up a little bit. It's pretty choppy, but this could be a sign of something positive happening. And yields, even though we gapped lower, they spent the rest of the day coming back and pretty much closed at their intraday high. Here's another thing that's interesting. We're still coming up with a zero answer for this. When we take the 1 month yield and subtract the 3 month yield, it's looking like we're going into some kind of a government shutdown. And this is probably reacting to that, since the last time we reacted was when we were getting close to this whole debt ceiling thing that was going on earlier in the year. But it's kind of strange for this to be having the same yield for their result. The 30 to the 5 year is still above the zero line and looking more normal. And we're still slightly above this midpoint of the trend channel going back to 2009. You could call this support potentially, but we've broke that other times. And so that's why I'm not as inclined to say that. I'm a little more inclined to look at this, where this is an arithmetic scale showing that we're coming down to this trend line, also going back to 2009, and we came a little bit below it, and now we're right on it. Then looking at the 10-year yield and subtracting the German 10-year yield, that comes up with a line because this past week, the U.S. rates surpassed the German rates, which had been the highest of all the different international yields that we follow. And then sometimes, even though it may not make a lot of logical sense, that can line up with what the U.S. dollar index is doing. The dollar's been going up and U.S. rates are going up. And so that's why we're seeing this climb. And so we're seeing the correlation at the bottom continue to go up. Then another longer term study, the 19-day exponential moving average of the advanced decline ratio. We never got extreme based on price, but we are seeing some improvement. We did get a bit extreme and we're starting to bounce up based on volume. Can that mark some kind of a bottom in the market? The S&P to utilities ratio is continuing to go up, which often matches the rise or fall of the S&P. And then the Staples to S&P 500 ratio, they go in opposite directions. So as this ratio is going down, that often means that the S&P is going up. And then I kept this on here. I haven't got the new email yet from Tom Bowley for his October statistics. So what's our outlook for Monday? We're still dealing with some earnings reports that are coming out. The UAW strike is still continuing, and that's potentially getting even bigger. We're still wondering, are we going to have a government shutdown? It's looking like that might be the case. Student loan repayments are going to start at the beginning of October. That could drain the economy. We're still negative, and we have a confirmed downtrend in the short and intermediate term, but there's some lingering signs of improvement that we're seeing, with the solid just bar chart by itself giving us kind of the best indication right now that things might be improving. The economic reports that'll come out on Monday, we'll get the S&P Global U.S. Manufacturing PMI, the final reading. The big one will be the ISM Manufacturing Index. And then construction spending will also be coming out. Keeping an eye on the geopolitical events, we could add the government shutdown to this. I didn't think it was going to go this far because it just depends on what games do they want to play and threats do they want to make, and then play hardball at that. Here's the economic calendar for the upcoming week, where it's going to be employment this week. We're going to get the JOLTS job openings on Tuesday. We'll get ADP on Wednesday, of course, jobless claims on Thursday, and then the employment situation report on Friday. The new Stock Traders Almanac statistics for October. Once we get into October, that ends the worst 6 months. Now, it's not like October is stellar. You can see over the last 72 years, yeah, we've leaned to the upside. We're up almost 60% of the time, but we're almost down 40% of the time as well. So that's not heavy odds right there. I won't talk about options expiration right now because that'll be coming up later in the month. But we're neutral to positive when we look at October 2nd, both for the Dow, the S&P, and the NASDAQ. Here's another new chart showing the S&P during an election year when the sitting president, and that's what we have right now, is running again. That's the green line. And we might chop around a bit in October, but then things tend to get more positive as we get into November and December. Also, keeping an eye on the Carson chart, we're getting into October where sometimes we see some strength in the earlier part of the month. And we're also seeing that with the NASDAQ during pre-election years. Doesn't mean we're going to avoid some weakness later in October, but at least at the beginning part of October, historically, we have seen a bit of a bounce. And we're seeing kind of that same thing with the S&P 500. Here's the green line. We do tend to see some bouncing going on here, but then be warned, there's historically some weakness after that. Here's the new chart showing October going back to 1950 during pre-election years, where we're up 10 out of 18, we're down 8 out of 18. So a slight positive advantage there. And then this, I don't deal with Bitcoin. I just follow it. I think it's kind of interesting and all that stuff. We're coming into a positive seasonality here. Jeffrey Hirsch, who puts out Stock Traders Almanac, this is the first time he's published a seasonal pattern for Bitcoin. And coming into the early part of October, which based on what's happened since 2018 to 2022, we tend to see some positive seasonality right now. Now, if you go from 2011 to 2017, you're still chopping sideways. If you use all years, you're not really showing much improvement there either. So our scenarios for Monday, leaning more towards the down one. That's what our charts are telling us for right now. But we're also asking the question, are things starting to improve? We're not going with the up one yet. We just don't have any confirmation of that. And we're not going with the sideways trend because both of our ADX charts are above 20. Our warning signs, the longer term trend signs, and I'll go through this in the weekly video, I should say the trend signals, we're still below that. And it's going to take quite a bit of power to break through those. Seasonality, and historically, we're seeing a bit better month. I'm keeping it on the warning sign for right now because it's not that we're looking gangbuster right now. Now, we get a few good days, and that might switch over to the positive list. The long-term equity put-call ratio is still going up. That's negative. The risk-on posture has been bouncing up the last couple of days, but it is showing longer-term weakness. All of our oscillators continue to be negative for the S&P and the NASDAQ 100. The cumulative new highs, new lows for the NASDAQ are showing weakness now for, it seems like, a couple years. The 3-month yield is still above where it was back in 2007. We're wondering if it turns and starts to come back down, will that give us a warning sign? But it's still barely flattening out and could be continuing to climb. The S&P is underperforming utilities, and the Staples to S&P 500 ratio is advancing, but I showed you that chart, and if you take the inverse of this ratio, it's starting to go back up, and that could be positive for the S&P. The Russell is below its 200-day simple moving average, and also wondering, is the head and shoulders top playing out with that chart? The parabolic SAR chart is negative, as is the vortex indicator, and then we're still dealing with earnings season. The longer-term seasonality and setups that are further back in the background, and I'll go through them in the weekly video, those are still there. The daily special K chart, it's coming down a bit, but it's still above that red line. It's positive. The S&P is still above the downtrend channel upper line. The Russell, the small caps, and the mid caps are still working off of recent golden crosses. The equity put call ratio, I put this on the list here, it's starting to go down, which could be positive. That's the 5-day simple moving average. The small and mid cap growth indicators that we look at are positive. The financial sector has generated a recent golden cross. So our conclusion, we're still negative right now. We have a confirmed downtrend, but are there things that we can look at to show some improvement? In the short term, we're still dealing with an oversold condition. Are things looking a little bit better? We can say pretty much that same thing in the intermediate term, and we're still positive in the long term. Thank you. I hope you have a really good weekend. I will be posting other videos over the weekend, so I will talk to you in the next video.